And we are thinking of everyone in that part of the world. For now, though, we're going to focus on the asset market reaction and bring in the mighty Matt Smith. He's the Director of Commodity Research at ClipperData, joining us from Louisville in Kentucky this morning. Matt, it's been a while since we've spoken, so thanks for joining us today. Let's begin on the impact overall, because we have two of Louisiana's largest refineries out. We have power outages hampering the restart. Are you surprised by the price reaction that we're seeing this morning?
Well, I think it's sending us a message, Dan. I think if we were seeing gasoline prices really charging higher, that would signal that there were real concerns about a number of these refineries, whether it's in Mississippi, Alabama, or in Louisiana there. But because we haven't seen that on the gasoline side of things, that's somewhat of a signal that we should see once power returns, they're probably going to be pretty much okay. On the crude side of things, seeing that really coming off too is also a signal. Gulf of Mexico production was knocked out by like 95% on Monday, but we're going to be seeing that returning sequentially in the days ahead. So really, it's sort of a net bearish situation at the moment for crude because that production is going to return quicker than those refineries. And so that's why we're seeing the response we are in the prices.
So, Matt, what do you think the impact is going to be in the short to medium term when it comes to Gulf imports and exports?
Well, the export side of things on the crude side, that they come out of predominantly Corpus Christi and out of Houston and Texas there. And so the export side of things are going to be relatively unaffected. What you are going to see is the issue with these refineries on, sort of the eastern side there, which, there's still debris in the waterways here. They haven't got power at the refineries. And so it's sort of 400,000 barrels a day, something like that, in terms of those crude imports that are not going to be coming in. So that's what we're going to be seeing on the flow side of things. One thing to say as well, Dan, is that we're still not quite at the peak of Atlantic hurricane season. That comes at a week on Friday here. So you're still going to see more storms potentially heading across the Atlantic and going into the Gulf over the next week or two.
That's exactly right. And this is something that oil market investors are pretty used to by now. But Matt, is there any early indication on how soon we might be able to see those refineries back up and running and exports and imports resuming at normal pace?
Well, I think it's really going to come down to the power side of things. It seems that there isn't too much damage just because of the signal that we're getting from that gasoline price there. So whether it's 1 week, 2 weeks, something like that's what it seems like, rather than that kind of worst case scenario where you can see a refinery flooded and equipment damaged, or that way it gets knocked out for 1-2 months. And so at this point, it seems as if it isn't that worst case scenario. So it's a matter of weeks rather than anything else.
Okay, and let's look at oil from a more macro perspective. I know you've been following some data out of China which shows that imports there continue to be low. What's at play here? Is there an innocent explanation or something more substantial?
It's really difficult to say, Dan, and you were just talking to the previous guest then about the manufacturing number coming out. And what we've been seeing from the crude side of things is that we've seen those imports really drop off as oil prices have risen through this year. And so that's really strange because we've typically been able to rely on China to be bringing in more oil every single year. It's been this bullish influence. And so it may be a number of factors here. It could be related to the fact that the economy is slowing, like with the manufacturing data, what we're seeing signaled there. It could be related to increased regulatory factors. We've seen taxes being put on bitumen, which is a heavier type of crude that comes out of Venezuela. Or it could simply be that the Chinese are trying to make the weather. And what I mean by that is that because they are the largest importer in the world, they could be just dialing back on those imports to try and push the price down. We're seeing a lot of crude being built up offshore China. We're seeing them drawing down their onshore inventories as well. And so they could be trying to push prices down to get to that point when they will return to the market and start buying again. So definitely something to watch there.
Very interesting. So what's also at play here is the OPEC calculus, because the Biden administration has been calling on those OPEC producers to increase production. Of course, we have the meeting coming up tomorrow. Your thoughts on what an OPEC output increase might mean for this market, and how much pressure are these producers going to be under from the Biden administration?
Well, I think with this meeting is somewhat a non-event in the fact that it's been well signaled by the delegates that those output increases are going to continue. That said, I think it kind of gives them a bit of leeway as well to mention that there may be some demand weakness here and signal to the market that in the months ahead, they may potentially pause on those output increases in case, we continue to see speed bumps in terms of the COVID situation. But the crazy thing is, though, Dan, when you look at the numbers, they're looking to increase by 400,000 barrels a day onto the market month after month after month, all the way through until next September. So unless we see, crazy demand continuing to really ramp up, it seems that they're going to have to pause at some point. And so it seems a matter of when rather than if. But in terms of the immediate term, it seems that we're going to get a fairly benign meeting.